January 29th, 2026. The world woke up to trading screens washed in gold. This was not an ordinary rally. It was a declaration. Gold broke through $5,561 per ounce, rising 99% in a single year. This was not a bubble. It was a structural shift, one that redrew the global map of financial power. Context of the crisis. Why did this happen now, and why with such force? To understand what is unfolding, we must look beyond the price itself. We are living through the gradual abandonment of faith in fiat money. Confidence in sovereign debt is cracking. Gold, once mocked as a medieval relic, has returned as the only anchor in a sea of collapsing obligations. Financial dominance and US debt. The United States, the world's dominant economic power, faces a monster of its own creation. National debt has reached $38 trillion, while annual interest costs alone have climbed to $659 billion. This has cornered the Federal Reserve. At its January 2026 meeting, the division was unmistakable. Rates were held steady, yet strong internal dissent called for cuts to protect the labor market. The message was clear: stability may now come before inflation targets. And this is exactly where gold thrives. The Great Decoupling. For decades, one rule dominated the markets. When real yields rise, gold falls. In 2026, that rule collapsed. Real rates reached 4.25%. Gold should have crashed. Instead, it surged. Gold severed its relationship with bonds and began trading as an alternative to the entire dollar-based monetary system. Today's investors fear currency debasement more than they seek yield. The central bank revolution. The question then becomes, who is buying at this scale? The answer is central banks. In 2025 alone, central banks accumulated more than 1,100 tons of gold. BRICS nations and emerging economies led the charge, including China, Poland, and Turkey. They are not buying gold for safety alone, but to reduce dependence on the dollar. The dollar's share of global reserves has now fallen below 57%. At this point, price no longer matters. Whether gold trades at $4,000 or $5,000 per ounce, the buying continues. This is not speculation. It is a long-term redistribution of power. Trump's trade policies. The story of 2026 cannot be told without its geopolitical shock. Donald Trump's return and his aggressive trade agenda have placed markets under constant tension. Gold has become the ultimate hedge against political uncertainty. Tariffs have reignited inflation fears, while threats toward Iran have pushed geopolitical risk premiums to extremes. At the start of 2026, as tensions in the Middle East escalated and nuclear facilities were targeted, gold surged above $5,400 within minutes. Gold now breathes in rhythm with crisis. Gold in the age of artificial intelligence. There is also a surprise few expected. Gold is no longer just money, it has become infrastructure. The artificial intelligence revolution demands massive physical resources, including data centers, advanced processors, and expanded energy grids. Gold's unmatched conductivity has made it a critical material in this transformation. Technology investment has surpassed $600 billion, driving unprecedented industrial demand. Silver, gold's close counterpart, returned 146% as spot inventories were depleted by solar energy expansion and data center construction. This is no longer financial demand alone. It is physical consumption. Gold versus Bitcoin and equities. In the asset race of 2025, gold emerged as the clear winner. It outperformed the S&P 500, and more importantly, it outperformed Bitcoin. Digital assets collapsed alongside risk markets during stress events, while physical gold held firm. Liquidity matters in moments of crisis. Gold absorbs shock. A single large sell order can push Bitcoin down 25%, while gold may barely move 2%. Looking ahead. Looking ahead, the question becomes what comes next. If debt pressure persists, analysts project gold reaching $6,000 per ounce. The Commitment of Traders report reveals something historic. Even producers, who once hedged against falling prices, are now buying futures. Still, caution remains necessary. A sudden resurgence in the dollar could trigger violent corrections, pulling gold back toward $3,360. Markets never move in straight lines. We are living through a new golden age. Gold is no longer a luxury. It is a structural necessity. Experts now recommend allocating 10 to 20% of portfolios to gold. In a world ruled by distrust, gold remains the only asset with no counterparty risk. It cannot be printed. It cannot be defaulted on. It cannot be forged. Will gold reach $10,000 per ounce? Perhaps. But one thing is certain. The monetary system we lived under for decades has changed forever.